All right. Hello, everybody. Thank you for your patience. Hopefully, everybody is able to get on. This is our first time to do a webinar like this, so appreciate your patience as we figure out the technology. There's always ways to grow during times like this, and this has been a great learning experience for us. And I've got Carson as a co-host. He is my millennial resident Chief Technology Officer. So if you have any issues, at the bottom of your Zoom window, there should be like a little Q&A button that you can ask questions for me. If we have time, we'll answer some questions at the end. And then also you can tell Carson if you're having any questions, and he can help you troubleshoot real time. So thanks for that. We're also going to try to record this session, so we'll be able to send you out a link if for some reason you can't hear me, which may not be a bad thing for some of you who hear me talk all the time, or if you can't see the video. Now, those of you who know me know that I have, and my team reminds me of this all the time, I do have an over tendency to communicate, which I view as a positive, but it is a delicate balance. And during times like this, I just want you to know that we care, we're working hard, and I will never apologize for caring. This is where our clients need us the most, and we are all in this together. And so the emails I've been sending, the videos, and now the webinar, this is us trying to continue those lines of communication. So thanks for your patience and for being a part of this, as I am learning how to do this as well. Let's see, I'm going to share my screen. Now you should be able to see the PowerPoint, and then I'm a lot smaller, which I have no comment there on that part. But here we go. So on basically, what I want to point out, this is no doubt been a crazy time in the market. I have not seen this in 20 years. And basically, if you look at this chart, about last week, we tested lows in the market. You can see right here, market was down about, this is the Dow Jones, was down about 35%. That was the fastest 30% drop ever in the market, I believe, from the sources I've been reading and people I've been talking to. And then now, as of yesterday, we were still down in the low 23% range. As you can imagine, with 10% swings like we've seen, trying to time this game is very hard and nearly impossible. I've been on at least 10 conference calls this week with other top advisors and economists and a lot of you clients, and we've seen some interesting dislocation in the market, a lot of firsts. Typically, when you have the market fall the way it's falling, things like technology and the high growth risky stocks are the ones that take the bloodbath, and things like dividend and blue chip type stocks usually are down quite a bit less. And technology was only down 10% or so as of a week ago, and a lot of the blue chip value type of dividend stocks were down, 25 and 30%. And so this is there's definitely some interesting things happening in the market that we're staying on top of as we rebalance portfolios and ways to kind of take opportunity from that. And I do recognize, and several of you have mentioned this, and I mentioned it in my video, it's easy to feel silly right now staying in the market when you feel like you're trying to catch a falling knife. It really is. But I want to applaud the 99% of you who are clients and other top advisors I've spoken to. They said the majority of their clients have not abandoned their long-term plan and not reacted and tried to sell and get out of this thing. Because as you saw the last couple of days, the market was up 15 to 20% in a matter of days. That's unheard of. And so that is why we don't want to get caught in that game. I want to go through some charts, and I won't spend long on these because everybody's probably seen plenty of charts and been inundated with data. But this one basically shows going back to right before the 2008 crash, there have been 62 occurrences here of major breaking news, if you will. Things like H1N1, Brexit, the tariffs, Bear Stearns, Lehman Brothers, all of that since just 2008. And a $10,000 investment in the market today is still at $28,000. So despite all of that, and yes, this is the biggest, let me go back. This is, since 2008, this is the biggest drop we've seen. 2008, keep in mind, the market fell from top to bottom about 50%, right? And we've seen about 35%. And there could be another bottom, and I want you to hear this part. because this is the main question we've been getting is when's the market going to hit bottom? There could be another leg to this. We've either already hit the bottom and now we're going to test the lows and kind of play in this range as more data comes out about the number of cases increasing. I don't think it's just going to be a straight recovery from here. And there's a chance that we test those lows again and maybe there's a last wave of panic selling where the market falls another 10%. And then at that point, it becomes so ridiculously cheap that the big institutional investors come in and buy into the market, and then there's a violent comeback in the market, which is why you do not want to be the person selling at that panic part of the market. Looking at, this is just a similar chart. This goes back to 1975. The same $10,000 grew to $1.7 million despite all of this bad news. You can see every year it gives you the headline and what caused the market to go down at some point during that year. So just another reason why time in the market is so much more important than timing the market. You've heard me say that a million times, but I just want to make that clear right now more than ever. And then if we look, so what this chart is showing in yellow, you will see during a given year how much the market was actually down. Maybe there was a correction that year, and then in blue is what the market actually did by the end of the year. The point of this is that every year it is normal to have a 10 to 20% correction any given year, and the market can still finish up. Case in point, 2018 right here, the market fell 20%, finished down only 6%, and look in 2019, the market dropped 7% at one point and ended up the year at 29% up. So this is all very normal. What is not normal is the velocity of the days and how quick this happened. But it is normal to have a 10, 15, 20% drop and the market can still finish up. Just to put it in perspective, this is going back again to 2007, right before the crash. Even compare, hey, David, I get this question, why wouldn't we put all of our money in gold or treasuries or CDs, et cetera? And this shows in blue, if you invested in stocks at the worst time, right before the 50% crash, you can see that down 50%, stocks still won after the last 10 years. They still won, beat every other asset class, and that's starting at a horrific time. So just something to, again, add perspective. Let's look at this chart, which goes through the history of bear markets and bull markets. A bear market is defined when the index closes down at least 20% from its previous high, and we did hit that, obviously, last week. The average bear market lasts about 12 to 18 months-ish, okay? That's in yellow here. So in 2008, remember I said it fell 50%, there's your down 50% number. It lasted 1.3 years, was that 15 months or so, right? And they usually take 2 to 3 years to recover back to a high point. Now, the question with this one is, it happened not in 12 to 18 months, it happened in 1 month. So is the recovery 2 months? Is it 6 months? Or is it the normal 2 to 3? My crystal ball is as foggy as anybody else's. I would say I think the recovery is going to be a lot quicker because, again, of the dramatic down, how fast it happened. But I don't think it's going to be in a month or two. I think we've got to cycle through some of the bad news, start to get our first doses of positive news with vaccines coming out or something other than the Fed stimulus package, which we've gotten the lift from the market there the last couple of days. So I think we're going to kind of play in this sideways zone for a little bit before we get relief, but could be potentially one of the best buying opportunities I know that we've seen, at least in my career, over 20 years. This is interesting, to me at least, maybe to you. This shows the number of days in a given year where the market has gained or lost more than 1% in a day. The average is 59 days a year. The market is up or down more than 1%. And that's a pretty volatile day. My goodness, we've had almost every single day this year, the market's moved more than 1%. And the last month, 10%, we become numb to 5% moves. The Dow can fall 1,000 points, 5%, and that's become kind of the norm. So unprecedented volatility we're seeing right now. More than likely, again, it's because this was not the fundamentals of the economy falling apart. This was a virus. This was an isolated event that then caused businesses to close, caused a lot of fear, a lot of panic, and a lot of unknowns now that everybody's trying to kind of figure out when when are businesses going to open again? What is it going to look like? Who's going to stay afloat? What is the stimulus going to look like? And we're going to talk about that in a few minutes. So takeaway here is just unusual volatility. Oh boy, election stuff. I promise I'm not going to get into the election stuff right now. You get enough of that on TV. But what's interesting about this chart, typically people think that stock market years are really bad years because they are typically volatile, but historically presidential election years have been positive in the market. And basically in years that a Republican was elected, the market average return was 15%, and a Democrat it was 7%. Don't pay too much attention. There's not a political undertone there. That's because in 2008, when Obama took over, market finished down 37%. So when you average that out, it's about 11% average rate of return during election years, regardless of Republican or Democrat. Does that hold true this year? Maybe, or is this a year like 2008 because we entered a crisis right before the election? That's to be determined, but just again, perspective is what I'm building here. This is kind of like, this is the investor roller coaster. This is also, you've seen this with a lot of different, psychologists use this all the time, just a typical emotional roller coaster, but it also applies to behavioral finance. You could argue that this is where we were a month or two ago. Dow's hitting all-time highs, S&P's at all-time highs, investors are feeling pretty good. You know, yeah, maybe a recession's coming at some point, but the economy looks good, we're feeling euphoric. Where are we at now in the cycle? Typically, when you hit the kind of panic button in the cycle, that's usually the bottom. I would argue that we're probably somewhere, we're more than worried, and there is panic out there. Whether we're right here, we have a little bit more down, or we're already kind of trending up, we're definitely at this place, because the reason we saw the panic selling over the past couple of weeks where individual investors, not any of you, because you have financial planners, but sold out of their 401k out of panic and then missed the last couple of days, and they're getting caught in this kind of cycle. And that's usually when the big institutional investors start to rebalance and come back in. So we think that's close, but just kind of showing you a visual there. This is actually looking at past epidemics and everything from HIV, AIDS to SARS to measles, etc. And this is just for, again, perspective, and this is not to minimize anything to do with this virus, because we know that it is a serious thing, but just to show you that this too shall pass, and in past situations, what the market has done, even when it took a hit. And I won't go into all this, but basically saying over the next 6 months or 12 months, after kind of the epicenter of the epidemic and the breaking news, what the market did and how it continued to rise. Still hope. Now, I alluded to this on my video I sent out earlier this week. We're doing all of our client meetings. Our team is working from home. We're utilizing, again, this Zoom technology 3 or 4 times a day with each other, with clients, and of course this webinar today. So we're definitely, our goal, and my goal as a leader of the team, is to keep my team safe and also keep our clients safe and take this seriously until we get to the other side of it. Couple of other things, what's going on in the Fed. We know Fed lowered rates to near zero. It's just unprecedented, and talks of some negative rate situations happening in the U.S. So what does that mean? Well, as far as the stimulus, so part of it is we've had the stimulus by lowering rates, right? And we can talk about refis and what that means and things you can do with that. But also the bill that got passed by the Senate is going through the House today. We know that the tax deadline has been pushed out to July 15th. We know that, and same thing with any taxes owed, so we have some relief there. We did find out confirmation that things like IRAs and Roth IRAs, your contributions, have also been, the deadline's been extended to July 15th. It looks like in the bill there's going to be no R&Ds for clients over 70.5, actually it's 72 now. Those are going to go away for 2020, so that's a big change. And there's going to be some hardship options where maybe you can pull money out of your IRAs or 401ks without paying the typical 10% penalty. And then there's a lot going on with small business loans and stimulus checks that are going out. Looks like $1,200 per adult, $500 per child. under a certain income level. So all those details are getting fleshed out. We have kind of like the 95% draft of where we think it's going to be. We just haven't sent out the our official summary by email until we know it's passed. Let's see here. So things that we've done in our office to be proactive. You know, if you're a client and you're joining this call, you would have noticed over the last year, we're not market timers, and we were just saying, look, this bull market's probably in the 7th inning. There's still some upside, but not near as much as there was. And so versus yanking money to cash and playing that game that we know doesn't work, we started pulling 2 and 3% slivers of our clients' portfolios over into conservative bonds and more value, like conservative type stocks, de-risking the portfolio for the past year. So when this hit, again, everybody felt it, we did too, but we definitely had de-risked the portfolio, and that helped protect, and most of our models were down significantly less than what the market is because of that. And so those things are important as far as being proactive without having to, so that we don't have to try to time these things right now. The other thing we did with all of you, and we've been on the phone all week having these conversations with clients, is what is your strategy for spending? This is why we talk about buckets all the time in my office. You know, I love my buckets, but how much cash do you have in your emergency fund and savings? How much cash do you have in your business? Can you make payroll? How much cash do you have set aside for things like upcoming taxes, even though they've been pushed off now? And then we want to at least have, we want to have that set aside. Then we look at the portfolio and make sure that we have several years worth of bond money. So if you said, David, if this thing got really bad and I got laid off for 3 years and we need 50 grand a year to live on, do we have at least $150,000, $200,000 of bonds in your portfolio to provide that if you were to exhaust your emergency fund? And then the rest of the money that we don't see being needed for that 3 to 5 to 7 years is sitting long-term in stocks. And the key to this game is for us not to have to ever be in a position where we sell stocks while they're down. If we can help you through planning, avoid making those rash decisions, which make it hard to ever recover, and use our cash and our bonds during this type of period when things are really bad, we will get to the other side of it. We saw it in 2008. We had one client that got out of the market, and that's it. And it really paid off. And those clients that went through that with us remember what that felt like in these same conversations, it's just been a while since we've been through it. So what are some planning items? What are some things you can do, and also other things that we're doing for clients who feel pretty calm and pretty settled and are just saying, hey, let's look for opportunities. Roth IRA conversions. This is a black and white, or this is not a black and white issue. This is more gray. This is something that email us one-off about if it makes sense for you. But because your IRAs are worth less in value, if you don't need it for a long time and you want to get some of that money in your IRA in a Roth so it can grow tax-free forever, this would be a great time to convert that, pay the taxes while that $100,000 is worth $70,000, pay taxes on the $70,000. Then when the market comes back, now you've got that tax-free growth forever. Key to that is you have to have cash outside of that IRA to pay the taxes. So you're proactively writing a check to the IRS so that in 10 and 20 years you're growing a tax-free asset. It's a great strategy if you're in a liquid situation and you have cash on the sidelines. Refining your mortgage, maybe. A lot of our clients have pretty low rates already locked in, which is good. So you may not need to do that, but worth calling. We've got several good preferred mortgage partners that we can get you in touch with just to ask the question, hey, does it make sense with closing costs and whatnot to go ahead and refi our mortgage and lock in? And then if you have any excess cash, dry powder, the biggest question I've gotten by far, and I can already see that we've had a lot of these questions during this webinar, looks like it's the most asked question, is now a good time to invest? Well, again, we're not going to time it perfect, but what we do know is we're 20% or more, even more after today, off of the highs. If you have a 12 month to 2 to 3 year time frame and you don't need this money, I think it's a great time to buy. You're buying 20% less where you would have bought a month ago, and even if this thing falls another 20% before it comes back, as long as you don't pull the plug down 20%, you're getting a pretty good starting point. I will say this, our clients that have bigger chunks of money, and I know that's all relative, meaning they sold a business or they're sitting on X amount of money in cash. We're doing that in stages. So if you said, hey, David, we've got $300,000 sitting in cash, we'd love to get in the market. Maybe what we do is we take $150,000, we get it in the account now, so we have the button ready to push. We find a big down day like today, maybe Monday, we invest half of it. We hang out for another week or so. We all hope the market goes up, but we feel like there probably is going to be another down tick, and then we buy there and we kind of deploy the money over the course of 1 to 2 to 3 weeks. Something to think about. We've been doing that for a lot of clients. And the next big thing that's going to happen on our end is a rebalance of all of our accounts. And that's, again, if you're a client, you've seen the emails on that. That's where we look at and say, hey, you're a 70-30 investor, 70% stock, 30% bond, and maybe now you're only 60-40 because your stocks have taken a beating. Does it make sense for us to go and rebalance and get you back to 70-30? We're going to look at doing that over the course of the next few weeks. Again, not a perfect time to do it, but history shows if you do some of these things like de-risk a portfolio as the market gets towards the top of its cycle, and then you rebalance when things once a year, and then also when things get really out of whack. And then the other thing we're doing that's not on here is tax loss harvesting, going through every single one of our client accounts one by one. And if we see an opportunity where we can sell a bunch of your stocks, again, sell, but we're immediately buying other mutual funds or investments. So we're keeping you in the market, but we're selling something, buying something similar so that we can take that tax write-off and use that to offset some other gains. It's called tax loss harvesting. We did it for a lot of you at the end of 2018. Right around Christmas Eve and New Year's, that was a fun time around here, but we got a lot of that done, and a lot of you still have benefits from then. So that's something we're looking at. Let's see. We are about done. Now, checking to see if there were any questions. Carson, were there any other questions other than the two that I answered that I saw that stood out, if you want to hop on?
Yeah, no other questions. I think one person had a question, just making sure they understood you right when you said RMD sounded like RND. So yeah, that's it. Just making sure that was communicated right. But yeah, that's it. You hit it all.
Okay, so required minimum distributions. That looks like those are going to be put off for 2020. So RMD. Well, great. I'll say this. I mean, during times like this, let me just encourage you again, just some thoughts here. Spend quality time with your family. Hopefully a lot of you have been doing that, and a lot of you have shared pictures and things with us you're doing, and learn something new, like we're doing with this webinar. And I've seen a lot of interesting things that some of you have posted on social media, and I want to applaud you for that. And give. I just encourage you, those of us who are on this call who are fortunate enough to maybe have portfolios to even worry about, to even be talking about financial planning, challenge yourself to give and help others who don't have income right now, who don't have investments and are worried about a lot more important things. How are they even going to pay bills? So challenge yourself. When you feel nervous yourself, how can you give? There's a great freedom to that, I found personally, and from talking from a lot of you and some of my mentors. Other things you can do, quiet times, gratitude journals, things like that have been things I've really enjoyed doing. Have helped me through times like this. And just finding ways to come together and connect with each other, strengthen relationships. I mean, I've done 5 FaceTimes with my niece and nephew over the past week, and we used to do that like once a month. And so it's just been a really sweet time in some ways, and doing that with my mom and dad, who are horrible at technology, but hey, they know how to do FaceTime now. So there's some kind of silver linings here. It would just be a shame for us to go through a situation like this and not really learn some valuable lessons and, gain some new perspectives. And I think a lot of us are. So I encourage you to do that. Thank you for listening today. We'll probably start doing these as often as we need to. I hope the technology on your end was solid. We'll get some feedback afterwards. You can shoot me or Carson an email. I'm david.w.adams@raymondjames.com if you don't have that. If you have a question or a follow-up or want to schedule a personal Zoom call or whatever, we're here for you. Thanks for everything. We're all in this together. This too shall pass, and we will talk to you soon. Right at 30 minutes. Perfect.